So now we're going to be getting into a little bit of the terminology. Before we did the definitions and the history, now we're going to be talking about options basics. These are going to be the things that I talk to you about in future webinars and in future tutorials. So this is going to be where you really need to kind of perk up, maybe get a cup of coffee and start paying attention. American options are options contracts, as I mentioned before, that can be exercised at any time during the life of the contract. Whereas European options, the contract can only be exercised during a specific period of time just before the contract expiration. The holder, as I mentioned, is the investor who purchases the option and who makes payment to the seller, who is the writer. And the writer is the investor who collects the option premium and has the obligation to fulfill the contract. In one contract, dealing with stocks represents 100 shares of the underlying stock. At the money options are the option where the strike price is equal to the market price of the underlying security. This is also going to be known as being on the dance floor. So if ABC stock is trading 50 and we're owning or we have bought a 50 strike, we are at the money. In the money is an option that has intrinsic value. A call is in the money when the underlying security is higher than the strike price. So if ABC stock is trading 51 and we have the 50 strike that we are long, it is in the money. And a put is in the money when the security is below the strike price. So remember, call up or put down. So if the strike is 51 and ABC stock is trading 50, our put is in the money. Out of the money is when an option has no intrinsic value and becomes worthless at expiration if it continues to be out of the money. A call is out of the money when the strike is higher than the underlying security. So if we own the 55 call and ABC stock is trading 50, we are out of the money because our strike is above. A put is out of the money when the strike is below the security. Remember, put down. We expect the market to go down, so if our put is 45 and ABC stock is trading 50, we are out of the money on a put. And the premium is the total cost of the option. And I will break down the parts that go into what consists of the premium later. But the holder of the option pays a premium to the option writer in exchange for the right but not the obligation to exercise the option. Meaning, if I don't want to buy the ABC stock at 45 when it's trading 40, I can just let this option expire worthless. The underlying security is the security that is the subject to what is being bought or sold when an option is exercised. So if I'm buying an ABC option, I should not expect to be getting gold in return. I'm only going to be getting ABC stock. An exercise is the transfer of the underlying security. So in our situation of a call, just to make things simple, if I bought the 50 call on ABC stock and it's trading 55 or it even just goes in the money, I can exercise my right for the writer to transfer that underlying security to me. Now that writer of that option has to come up with the underlying security to give to me. So if he didn't originally own that stock, then he would have to go in the open market and buy it for whatever he could and then sell it to me generally at a lower price. The terms are the conditions of the options contracts. It denotes the underlying security, the expiration date, and the strike price. So it is creating a contract. So as I mentioned before, if I buy an ABC stock, I should not be receiving gold in return. I'm going to be getting ABC stock, but I have to do this before that option expires and at the specific strike price that we originally agreed upon. And I kind of went over this already, but this is part of the terminology. A call gives the holder or the buyer the right but not the obligation to buy the underlying security at a specified price for a fixed period of time. So it's only within that contract. We have weeklies, we have monthlies, we have leaps, which are really long-term options contracts. So whichever one that you've entered into is the time frame at which you can try to exercise that option. Remember, a holder of a call is bullish. He thinks that the call or the underlying security is going to go up in value. Remember, call up. Covered call is an option strategy where the writer of the call option simultaneously holds a long position in an underlying security for share basis. So one contract is worth 100 shares of stock. So if I do one call, I should have at least 100 shares of that underlying stock to make it a real covered call. ABC stock example, if I wanted to sell the 55 call and I owned ABC stock at 50, I would need 100 shares of ABC stock to make this a real hedge. So this is, like I said, used in hedging strategies to increase your portfolio value or in a neutral stock assumption, meaning ABC stock only trades for the last year between 43 and 45. So I'm selling a 55 call because if it gets up there, I'm willing to sell it. It hasn't gotten there, it's all-time highs maybe. I'd be willing to sell my stock there. And remember, sell out of the money calls when you're doing this covered call. You sold a call below the market, you're automatically in the money and you're going to get exercised. So you'd be selling your stock below where you could sell it on the open market. A put gives the holder the right to sell the underlying security at a specified price for a fixed period of time. This is just the opposite of a call. The holder of a put is implementing a bearish strategy. I think that the equity is going to go down. I'm not sure, but this is a way to limit your risk for a bearish trend or a bearish assumption. And remember, put down. Covered put is an option where the writer of a put option holds a short position, which this is a little bit further along the lines of not really being basic, but holds a short position in the underlying security on a share-for-share basis. Remember, one option is worth 100 shares of stock. So remember, a short position is selling a stock short. So if I was short ABC stock, which means I've sold ABC stock 100 times and I don't own that stock. And the writer of a put sells the put to kind of hedge his risk to the upside a little bit. If ABC stock started rallying a little bit for me or rallying against me, I should say, and I sold a put, I could increase my cost basis a little bit. By collecting some premium, I can increase the price, so to speak, of where I was short that particular stock. And remember to sell out of the money puts. You want to sell it above where you're short. What are naked options? It's a position where the writer of an option does not have an offsetting position in the underlying security. It really could go both ways. A naked option could be where you buy it, but generally speaking, naked options traders are the ones who are selling these options. And thus, this creates no protection against adverse price movements and theoretically has unlimited risk. Meaning if I sell a call, it can really go to infinity. If I sell a put, they say that there's unlimited risk, but as we all know, a security really cannot go negative. This is a little bit of review going into this, but these are the participants of an option. The buyer of a call is bullish, so always think call up. The seller of a call option is bearish or market neutral. He thinks the market's either going to go sideways in ABC or it's going to go down in value. The buyer of a put option is also bearish. He thinks that the price of ABC stock is going to go down, but he's not really sure and doesn't want to take a lot of risk. So he's bearish. Think put down. The seller of a put option is bullish. He thinks that ABC stock is going to go up or kind of remain flat. Market neutral. He just wants to see the price of his strike go to zero anytime he's selling an option. So I appreciate your time spent with me today, and good luck and good trading.
Bulls can take control and push this up, or the bears take control and push this down to the 1400 level. That's going to be setting up for this week. All right, can't take that, take it easy.